We're analyzing WestRock, stock ticker WRK, to see if it's a great business on sale. This analysis is around 10 minutes. It's going to be intense, but it's going to be worth it. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for WestRock. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing WestRock for your stock portfolio. Before we get into these valuable metrics, let's understand WestRock's stock performance. Right now, WestRock trades for exactly $29 per share. Year to date, their stock price is down 18%. In the last 5 years, WestRock's stock price has been cut in half. They're down 50%. In the last 10 years, they're also down 50%. Going back prior to the global financial crisis, however, WestRock's stock price is compounding at 8% annually. Right now, WestRock pays a big 3.71% dividend yield. That's an above average yield. WestRock's average dividend yield throughout this time is in addition to their returns in their stock price. WestRock trades $14 below their 52-week high. They're trading just $2 above their 52-week lows. Just under 2% of their shares are sold short. WestRock is a big business. They have a $7.4 billion market cap and a $17.3 billion enterprise value. The burning question is, why should we be paying close attention to WestRock? WestRock manufactures corrugated packaging and consumer packaging such as folding cartons and paperboard. After the merger of Rock 10 and Midwest Vaco in fall of 2015, WestRock became the largest North American producer of solid bleach sulfate and the second larger producer of containerboard, which is used in the production of shipping containers. Now that we have this understanding, let's get into the numbers. Starting with metric number 1, we want WestRock's average return on capital in the last 5 years to be above 14%. The average business earns about a 7% return on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. WestRock's returns on capital have swung throughout this time. They hit a low of just 5% in 2020. In their last year, they earned 8% returns on capital. When these are averaged out, WestRock earns about 6.8% returns on capital in a given year. That's about average, just about half the benchmark we're looking for, meaning this is an X on metric number 1 for WestRock. Metric number 2, we're looking for revenue, net income, and free cash flow growth. All three have to be up for this to be a check. This metric's all or nothing. We'll include WestRock's numbers up until today when we calculate this growth. During this time, WestRock's grown their revenues by 30%. Their net incomes are down both from their fiscal 2018 until 2022, and in their last 12 months, their net incomes or their earnings are actually negative. This is due to both restructuring charges and impairment of goodwill. Even if we back those out, WestRock's earnings are still down over this time. Their free cash flows have also declined by 8%. With both their net incomes and their free cash flows being down, this is an X on metric number 2. Metric number 3, we're looking at WestRock from the view of an individual shareholder. We want to see earnings per share growth. As we just learned, WestRock's earnings are now negative in their last 12 months. If we backed out their impairment of goodwill and those restructuring charges, their earnings would be positive, but they'd still be down over this time. WestRock has bought back about 2% of their shares. These small share buybacks are not enough to outpace the decline in their earnings. This is an X on metric number 3. Metric number 4, we're looking for free cash flow per share growth. A similar story here. WestRock's free cash flows have declined by 8%. With the company buying back only 2% of their shares, that's not enough to offset their declines in their free cash flow. From fiscal 2018 to 2022, they did grow their free cash flows per share. Those again are down in their last 12 months. Hence, this is an X on metric number 4. Recapping where we stand currently, we're still looking for our first check of the day on WestRock. Does the business have what it takes to turn this around? In recessions, it's overly levered businesses that can have the biggest losses. Metric number 5, we want WestRock's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. WestRock added on to their net debt position over this time. They were reducing this in their last few fiscal years, but they added on recently. They ended their last fiscal year with about $8.3 billion in net debt. Right now, they have just under $10 billion of net debt. During this time, WestRock has only produced $5.6 billion of free cash flow. That's just over half of their current net debt position, though that's not enough to fully support it. This is an X on metric number 5. Dig into the company's filings to understand if this will cause problems for the business. WestRock is still looking for a check. Can the company pull off a check in our final metric? We'll find out right after we cover our bonus. As our bonus, we're looking at WestRock's dividend profile. Right now, WestRock pays a big 3.71% dividend yield. That's almost double the dividend yield you get from an S&P 500 ETF. People make mistakes all the time by blindly chasing dividends, so we want to see these are supported by their free cash flows. In all 5 of these years, WestRock has supported their dividends using their free cash flows. WestRock actually shrank their dividend payouts, meaning they have a lower dividend payout ratio today, even though their free cash flows have declined. It's good to see that WestRock supported their dividends using their free cash flows, and they're being mindful of where they need to allocate capital. However, with a large debt position for the business, their dividend could still be under some pressure, as free cash flow can be used to reinvest back into the business, make acquisitions, buy back shares, pay dividends, or pay down debt. While this is a snapshot of their last 5 years of performance, it's no guarantee for the future. WestRock does support their dividends now, and they have over this time. This is a check on our bonus. The big metric of them all, metric number 6, we want WestRock's average 5-year free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for WestRock. Right now, WestRock has a $17.3 billion enterprise value. This accounts for both their market cap and their net debt position. It views WestRock similar to it being a private company. In the last 5 years, we learned the business produced $5.6 billion of free cash flow, meaning in an average year, they produce about $1.1 billion of free cash flow. When that's divided by their $17.3 billion enterprise value, we get about a 6.3% average free cash flow to enterprise value yield. On a current basis, WestRock's produced about $855 million of free cash flow in their last 12 months. When that's divided by their $17.3 billion enterprise value, it gives us about a 5% current free cash flow to enterprise value yield. Both of these are coming in above the yield of the 10-year treasury, right around the risk premium we're looking for, meaning WestRock has done it. They avoid going 0 for 6 on our analysis, as they get a check here on metric number 6 and they get a check on our bonus. Don't just run out and go buy the business. We still need to estimate their fair value per share. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze WestRock, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with WestRock's current free cash flows and using historical assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for the business. Assuming WestRock grows their free cash flows at 4% annually for the next decade. Then in the following decade, assuming this growth rate is cut in half and they grow at 2% annually, if we add in WestRock's tangible book value, which gives an estimate of their net worth, if we're looking for a 15% rate of return, which is what Warren Buffett wants from his investments, from today's valuation multiples, if these stay the same for WestRock, an estimate of their fair value per share is around $37. That's up $8 from their current stock price. There's potentially a slight margin of safety in the business. Keep some key points in mind. WestRock has not been a predictable business in its past. That could also be the case in the future, which would affect our assumptions. WestRock's performance has been declining in the last couple of years. You need to have an insight into the business to understand when or if this will end. Also, this discount rate is an estimate of total returns to shareholders based on their free cash flows. It includes both their stock price appreciation and their dividend yield. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to WestRock, but we have to address something first. We've covered the numbers, but the qualitative factors may be even more important for WestRock. What are they? Let's find out. Looking at the factors supporting a long thesis, number 1, WestRock's recent investments in South America will provide an avenue for volume growth outside of North America. Number 2, WestRock Packaging Corporation of America and International Paper could remain disciplined in taking economic downtime when needed in order to safeguard prices. Number 3, WestRock's strategic transformation can remove low-performing assets from its portfolio, which could enable margin expansion and higher returns on invested capital. But we'd be remiss if we didn't cover the negatives of the business as well. Looking at the factors supporting a short thesis, number 1, WestRock's limited exposure to emerging markets increases its reliance on North America, and the firm will likely see a material decrease in revenue and profitability during an economic downturn in the region. Number 2, following years of industry consolidation, WestRock's growth prospects can be limited as future acquisition targets will likely come at unattractive prices. Number 3, despite a period of attractive margin expansion in containerboard production, the best days are likely behind WestRock as new capacity weighs on linerboard prices. There you have it for a balanced perspective of some of the qualitative factors of WestRock. Now it's time to give our rating. In analyzing WestRock, stock ticker WRK, the business earned just average returns on capital. While they grew revenues, their earnings and free cash flows were down. Even though they bought back some shares, they were down on a per share basis. WestRock looks like it uses more debt than their free cash flows can support. Again, look at their filings to see if this might be an issue or not. It's worth reiterating this analysis is not financial advice. WestRock has supported their dividends using their free cash flows in all 5 years. Even though their free cash flows have declined and they've cut their dividend, WestRock may look attractive based on their free cash flow to enterprise value yields compared to the yield of the 10-year treasury. When we performed our discounted cash flow analysis, if WestRock's valuation multiples stay the same, you believe those historical assumptions, and you want a 15% rate of return, an estimate of WestRock's fair value per share is around $37. That's $8 above the company's current stock price. Again, this is not a buy or sell recommendation of any security. Looking at all the factors of our analysis, WestRock looks like a modest candidate for further research. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about WestRock, and let me know what business to look at next in the comments below. Thanks for learning about WestRock with me, and have a great day.